Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. And before we start today's episode, I just really want to give a big thank you to all of those that have continued to support us on the show's Patreon account. From the deepest part of my heart, thank you so much for your support. So today we have a really special episode for our friends out in BC. I was asked by a fellow listener to cover the proposed changes to the Municipal pension plan. And this is a special pension plan that covers municipal workers in BC and is one of the largest pension plans in Canada with over 35,000 members. And now, when we're focusing on this one pension today, this change is actually part of a larger trend that we see going on, where pension plans are changing how they operate, and most importantly, how much their members can receive. These changes are done for many different reasons, and it wouldn't surprise me if other provincial plans see similar changes in the upcoming years. So this pension plan is classified as a defined benefits plan, meaning that the amount received is based on a calculation that includes the years of service, average earnings, and more. This is in contrast to a defined contribution plan or a group plan, where your payout is based on the contributions made and their performance. So this BC pension plan has been fairly unchanged since 1966, and it now looks like it's going to be going through some serious changes that will affect all members. And this pension actually includes a couple different groups, but we're going to be mainly focusing on Group 1, which includes 97% of the municipal workers. It really just excludes police officers and firefighters. So there are three major proposed changes to the pension plan that are scheduled to go in effect on January 1st, 2022. And a key detail for all of these changes is that any service earned before this date will still have the old rules applied to it, and service gained afterwards will fall under the new rules. So behind the scenes, these plans will essentially be turned into a mathematical monster of Frankenstein. And I'm really not envious of the person that's responsible for making sure that all this math works. So the first big change is increasing the lifetime pension amount, which is really the amount that is paid to members when they retire. And on the other side of this equation is eliminating early retirement benefits. These proposed changes essentially shift the funds from early retirement benefits to the lifetime pension payments. And the reasoning for this change provided by the pension plan is that only a fraction of pension members benefit from the early retirement benefits, but all members pay for them. Unfortunately, these changes also alienate long-time employees that have been working with the expectation of early retirement, have made past career choices based on these expectations, and already have retirement plans in place. The early retirement benefits that are being eliminated are bridging benefits and an early retirement subsidy. So bridging benefits are an amount paid to retired pension members until they turn 65, so that they're not required to take out from their Canadian pension plan at a reduced rate. The early retirement subsidy is an additional payment that is made to those that retire early. And these benefits are actually fairly common in governmental employee pension plans. So those that have service before the January 1st, 2022 cutoff date will still be able to access the early retirement benefit based on service made before the deadline, but will not accrue any more benefits after that date. So this means that there will still be some of these early retirement benefits to existing members, but the amounts will be a lot less than what they would have received if the changes didn't occur. And this, of course, can lead to inadequate streams of income if they decide to retire early. To help offset this drop in income, those that choose to retire early can purchase a temporary annuity that will help provide additional income until they receive their CPP or choose another end date. The downside with this option is that the annuity is paid by a member's pension and will reduce the lifelong pension amount that they receive. So this reduction in the lifelong pension amount can lead to cash flow issues in retirement and can possibly lead to other problems like not being able to support oneself if an emergency arises or having to care for a dependent. This proposal will also change the rules when an individual can retire early and qualify for their full pension. This is being done by eliminating a common rule found in pensions that allow early retirement when one has collected enough years of service and reaches a specific age. For this pension, it's called the Rule of 90, and what this means is that you can retire early if your age plus years of service equal 90. So for example, one could retire at 55 if they have 35 years of service, as this equals to 90. And alas, this rule is expected to be no more and will be replaced by a simple reduction of 6.2% for each year that one retires before the age of 60. And yet again, those with service before the deadline will fall under the old and new rules. And I can assume that this will become a very complicated equation. The next big proposed change is to how much has to be contributed every year to the pension and how the pension payout is calculated. The current way that contributions work in the plan is that plan holders contribute 8.5% of their earnings below the YMPE amount, which is currently sitting at $58,700, and 10% on all income above that. The new proposed change will streamline this into one static contribution amount of 8.61%, making it easier to determine one's contributions. And if the new proposed plan kicks in, what we're going to see is that those that earn above the YMPE will see a small bump in pay, as actually less is being taken to fund the pension. And those that earn under the YMPE will actually see a slight reduction in their take-home pay. And the way that you receive the pension is also changing. The base salary used in the calculation is the highest average annual earnings over a 5-year period. Like contributions, there were 2 tiers of rates that were used, with 1.3% received on base salary below the YMPE and 2% above. These would then be multiplied by years of service to determine how much of a pension was paid to the employee. Now, the proposed plan will change this to one static amount of 1.9%. So this means that the portion of salary below the YMPE will actually receive a fairly large bump, and those that are earning above the YMPE will have a very slight decrease in overall pension payments. So like all the other changes, all years of service earned before the deadline will fall under the old rules, while all earnings afterwards will fall under the new rules. So that's it for the major changes. There are some other types of rejigging of accounts, but these are the major ones that will be impacting individuals. And what we see is that these changes will essentially streamline how the pension is calculated and, in theory, increase the lifetime pension that most members receive. However, there are some segments of the plan members that will be negatively affected by these changes. Long-term municipal workers that started their careers at a young age will now have a much harder time funding an earlier retirement and may be forced to work longer than they planned. And many of these employees made crucial career choices throughout their lives that were based around receiving this pension. And very often these individuals may have intricate retirement plans that now have been dashed by the changes. Many would have been planned to retire at 55, but this may not be a possibility for them anymore. And the employees that have been negatively impacted by these changes are reporting that they feel like they've been treated unfairly, especially since they've typically dedicated very long periods of time, to working in this career. So that's it for today, but thank you so much to the listener that made the recommendation for today's show. And as always, if you're enjoying the show, please consider sharing with your friends and family, and also consider rating it on whatever podcast provider you are using. All ratings really help out. So take care and talk to you soon.